Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 85 on October 26th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Amarin Corporation, the Gold Miners ETF, and the Williams companies, and we discuss three new trades on Smile Direct Club, IBM, and the Semiconductor ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets moved higher this week on strong earnings reports, several strong reports. The Dow Jones Industrial Average gained 187 points, closing at 26,958 points this week. The S&P 500 index finished the week 36 points higher, closing at 3,022 points on Friday. Now, the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. So the topic we'll discuss this week is intrinsic value. And this conversation really is a function of what happens at expiration as well for options, since yesterday, or actually last week, was options expiration. So in layman's terms, intrinsic value is the amount of money your option has to be worth based on the price of the underlying stock or futures. So let's assume you have a call option with a $25 strike. If the stock price is $24 per share, how much intrinsic value do you have? Well, if you said zero, you're correct. If you said anything other than zero, you're incorrect. Now, does that mean the option will be priced at zero? No, because there's a thing called extrinsic value that we'll cover next week. The option may be expensive based on other factors, even though the intrinsic value is zero. Now, if the stock price is $25 per share, what is the intrinsic value? Well, the answer is still zero. If the strike is the same price as the underlying, there isn't any intrinsic value yet. So with a call that has a $25 strike, what is the intrinsic value if the stock price is $26 per share? Well, this time the answer is $1, and that's because $26 minus $25 is $1. With that $25 strike, that means you'll actually have the opportunity to pay $25 for a share of stock that is trading for $26 per share in the market. So let's do a quick example with the put option, and hopefully the call examples make sense to you. So with the put option, it's the same scenario. We just have a put option with a $25 strike. So at $26 per share, what is the intrinsic value? Zero, that's right. And at $25 per share, what is the intrinsic value of the put? Zero again. You're correct, because it's a $25 strike, and that's the same as the $25 per share. So there's no intrinsic value. At $24 per share, what is the intrinsic value of that put option? $1. If you said $1, great, now you're cooking with fire. And at $20 per share, what is the intrinsic value of a put with a $25 strike price? If you said anything other than $5 per share or $5, you're incorrect. That put will have $5 of intrinsic value. Now, if this is hard for you to understand, you should definitely email me. I have some resources that will help you understand options in the most effective manner. So just email me and we can set up a time to speak, or I can just send you some more information. You can reach me at eric@theweeklyoption.com. That's Eric at theweeklyoption.com. So let's dive into the trade review for last week's trades. We'll start off, as we always do, with the covered call. We looked at Amarin Corporation, symbol AMRN. A as in Alpha, M as in Mike, R as in Romeo, N as in November. At the time, the stock was trading for $16.13 per share, and I looked at buying that stock and selling the November 17 call at $1.80, hoping for a maximum return of 16.55% in 4 weeks. Well, Amarin stock closed 42 cents higher on Friday, ending the week at $16.55 per share. The call we sold is 19 cents higher in price, leaving us with a net profit of 23 cents per covered call right now. And that's really if you were to exit this trade today. Now, our highest profit in these covered calls is typically reached, and I say typically because there are exceptions, but the way I'm pricing it, our highest profit is reached when the stock finishes above the strike of the short call option, which is $17 per share. So since the stock is moving in the right direction, there's really nothing to do but watch and wait. This one is actually working, so hang tight and keep an eye on it. Now, our second trade was a credit spread last week. We looked at the Vectors Gold Miners ETF, symbol GDX, G as in golf, D as in Delta, X as in X-ray. At the time, the stock was trading for $27.12, and we sold the November 27.5/28 call spread, collecting 16 cents, which can yield a maximum loss of 34 cents per spread. Well, shares of the Gold Trust ETF grew 62 cents, ending at $27.74 per share this week. The out-of-the-money call spread we sold is now more in the money. In fact, we have surpassed our break-even point in the stock, which would warrant closing the trade and taking the 10 cents loss per spread. So right now we're down 10 cents on this trade. And we could lose an additional 24 cents if the stock continues to go higher. Now, I keep looking at the price chart, and that leads me to believe that the stock might actually start to continue this lower trending channel it's been in since early September. And if that's the case, I expect this stock to start falling in price. So I'm not going to be quick to sell a put spread again or anything against this call spread until I know that the stock is definitely going higher. The worst thing that can happen is if I go ahead and turn this into an iron condor where I sell a put spread against it, and then the stock runs against me, almost runs lower, almost guaranteeing that I reach my maximum loss, even though I'd be lowering my maximum loss a little bit. So overall, my suggestion is to simply wait for more information. We have 4 more weeks prior to expiration, so in a few days we will have a better clue on where the stock is going and if it's breaking out to the upside or if it's actually going to go ahead and continue on the downward trending pattern that it's been on. So I'm looking to hold tight for a few days, even a day, just to get more information on where the stock price might be going. Since we are short a call spread, we want the stock price to go down, and that's why we lost money this week. We lost the 10 cents is because the stock actually grew 62 cents. And then our final trade this week is the debit spread. We looked at the Williams Company, symbol WMB, Whiskey Mike Bravo. At the time, the stock was trading for $22.91. We looked at buying that November 24-23 put spread and paying 65 cents for it, which can yield a maximum gain of 35 cents or 53.85% return in 4 weeks. Well, Williams Company's shares grew 33 cents this week, closing on Friday at $23.24 per share. The in-the-money put spread is moving towards being out of the money at this point. It's more at the money. And our break-even point on the trade is $23.35. So we haven't reached our break-even point yet. We're still 11 cents away from there. And the main reason this trade still has any value to us is because we bought the November 24 put. That put right now has 76 cents of intrinsic value at the moment. So even though the spread lost money this week, I mean, we'd lose 15 cents if we tried to close out the spread today. We still will make money on this trade as long as stock prices stay below our break-even point. And I still feel like the stock could make another leg lower in price. So I'm more prone to rate this one out as well. Wait for a few days and see what happens to the underlying stock, or decide if I'm going to protect this trade by selling a lower strike put spread. So oftentimes, if I own a spread, I'm going to look to actually sell a lower or higher in the case of a call spread, but sell another spread against it to mitigate some of the loss. That's it for the trade review this week. Let's dive into the new trades for this week. So we'll start off as usual with the covered call. And this time I'm looking at a company that had an IPO not too long ago. We're looking at Smile Direct Club, symbol SDC, S as in Sierra, D as in Delta, C as in Charlie. Stock ended the week at $11.38 per share. And I'm looking at buying that stock and selling the November 12 half call against it, which could yield a 17% return in 3 weeks. Now you enter this trade by buying SDC shares for $11.38 and selling the November 12 half call at 85 cents. This trade makes the most money if stock prices finish above $12.50 per share, and the break-even price on this trade is $10.53. Our next trade this week is going to be a credit spread on IBM, International Business Machines, symbol I as in India, B as in Bravo, M as in Mike. The stock ended the week at $135.44 per share, and I'm looking at selling the November 134 put spread at 46 cents, which can create a maximum loss of 54 cents per spread. Enter this trade by selling the Nov 135 put at $2.56 per share and concurrently buying the November 134 put for $2.10 per share. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $135 per share. The break-even price on this trade is $134.54. And I love being able to use options to be able to make money on some of these higher dollar stocks that I otherwise might not want to allocate the capital to purchase. So just buying 100 shares of IBM right now, you're going to pay $13,544 plus your commission, right? Here I presented a trade where you can collect $46 and your maximum loss on it is $54. That's significantly different than $13,544. So that's one of the things I like about options, and that's also where the leverage comes in. People oftentimes will comment on the leverage that you can get with options, and that's because you're able to control or profit on stock movement without putting forth the full amount of capital that's required to buy that stock. So our last trade for the week is going to be a debit spread. We're looking at the Semiconductor ETF, and I love these ETFs. I think I told you guys in the past, I traded ETFs at the CBOE, at the Chicago Board Options Exchange, and they just made sense to me. Maybe we'll discuss that a little bit at some point, but when you trade an individual company, you're exposed to all of the individual factors that can either increase or decrease the value of that company. So management team decisions or changes, the equity, equity announcements, earnings announcements, any dividend payouts, any bad news, bad press, anything that will affect that one company and maybe not all the others in the industry, you are affected by. But when you trade some of these ETFs, much like another index or equity index like the S&P, when you trade the ETF, you're trading a basket of companies, or really you're trading something that is priced off of a basket of companies. So I'm less concerned about individual company news or individual company earnings and any other things that affect individual companies. I'm more concerned about the overall industry. Now that doesn't guarantee profit, but it does at least help me minimize the amount of white noise that I have to pay attention to for individual stocks. So back to the trade, we're looking at a debit spread on the Semiconductor ETF, symbol SMH, S as in Sierra, M as in Mike, H as in Hotel. The ETF ended the week at $127.03 per share, and I'm looking at buying the November 126 half, 127 call spread, paying 32 cents, and that can yield a maximum gain of 18 cents or 56.25% return in 3 weeks. Enter this trade by buying the November 126 half call for $3.05 and selling the November 127 call at $2.73 concurrently. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices finish above $127 per share. The break-even price on this trade is $126.82. Now that's it for this week's trades. I'm going to go out. I can hear some children in the neighborhood trick-or-treating. I guess that's a thing on Saturday instead of later in the week, but should be a good time. I hope you guys are having a great weekend, and thank you so much again for those of you who email me and let me know that you listen to the show. It's fantastic. I really enjoy it. I get all of your emails directly. Those do not go, typically don't go straight to my assistant. I like to get those directly. So keep emailing me. Continue sharing this with a friend. We're growing. The number of people listening are growing, and that makes me happy, makes me smile. And you guys are awesome. I love it. So thank you so much. Have an amazing weekend. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.